Hello and welcome to the Tech Corner. I'm George Tsilis, Senior Markets Contributor here on the Schwab Network, where every single week we highlight a new technology company. And this week, we're going to be highlighting one of the biggest names out there in the technology space, NVIDIA Incorporated. NVIDIA is a leading technology company. In fact, it's one of the lead architects in the artificial intelligence secular movement we've seen across the technology space in the past year and a half. NVIDIA is primarily known for its innovations in accelerated computing. The company has grown from a GPU manufacturer into a full-stack infrastructure provider, offering graphics, compute, and networking solutions. In fact, its compute and network segments encompass data center computing platforms, autonomous vehicle solutions, robotics, and AI enterprise software. Its graphics segments include its GeForce GPUs, generally used for gaming, professional visualization, data centers, and the automotive markets. But the biggest growth driver for NVIDIA in the past 2 years, essentially, is its data center solutions. It is known to have renowned scalability, enabling the integration of thousands of GPU-accelerated servers into unified computing platforms. These are crucial for developing AI applications. The company's GPUs are celebrated for their parallel processing capabilities. These are essential for deep learning algorithms and AI solutions. Some of NVIDIA's competitors include domestic suppliers like AMD, which produces both CPUs and GPUs, Intel Incorporated. NVIDIA also collaborates with major manufacturers like Taiwan Semiconductors, as well as AI server names like Supermicro. The other thing we have to consider is international competition. Huawei is a big Chinese technology firm. They are starting to encroach on NVIDIA's market share. Now, some of the unique value associated with NVIDIA's technologies lies in its comprehensive platform strategy. This integrates hardware, software, and services to deliver cutting-edge solutions across various industries. NVIDIA's strong partnership with leading cloud service providers and its robust data center solutions further reinforce its market position. This company is the preferred choice for enterprises seeking scalable and efficient computing infrastructure. Now, in recent news, NVIDIA posted their latest Q4 earnings and sales report. From a non-GAAP earnings standpoint, the company generated 89 cents, beating the estimates by 4 cents. This was a 71% growth in earnings compared to the same quarter last year. The other thing is their top-line sales beat the estimates at $39.33 billion. This was a growth rate of 78% in sales compared to the same quarter last year. The company actually guided higher for next quarter's revenue number. However, there was a little bit of a hiccup in their gross margins, which are expected to be lower. This is from the fact that they're launching their new Blackwell chips, which essentially reduces the scalability compared to their old Hopper technologies. Slightly lower gross margins are estimated due to the new Blackwell platform rollout. Estimates suggest NVIDIA has about 90% market share in the GPU sets for data centers. Big tech continues to invest heavily in artificial intelligence. This is bolstered by strong spending from leading cloud providers like Microsoft and Amazon. Now, there's no doubt NVIDIA has developed a competitive lead in parallel computing over the last decade. The company's strategic focus on inference engines positions it well to capitalize on the next wave of AI spending. NVIDIA's extensive software ecosystem also creates a lock-in advantage. This is unmatched performance and efficiency, which is expected to consistently drive profit margins in the long run. Now, there's no doubt NVIDIA has high profitability compared to its own historical averages as well as to its industry group peers. High gross margins suggest the company's efficiency in converting sales into profits. If we take a look at the gross margins of NVIDIA in the last 4 quarters at nearly 75%, compare that to the sector median around 50%, it's significantly higher. Net income margin also is very high for NVIDIA at around 55% of sales. Comparing that to the sector median of 4%, it's an extremely well-positioned company that can pass on high prices to its end markets. Now, one of the more striking valuation metrics to consider for NVIDIA is its PEG ratio. It's basically the PE ratio to the company's growth rates. If you actually consider the earnings growth estimates for the next fiscal year at around 67%, as well as a PE ratio on a forward basis of 26, this suggests the PEG ratio for NVIDIA is less than 0.5. A PEG ratio of less than 1 would be considered fair value. Now, aside from some of the positive attributes of NVIDIA, we have to consider some of the concerns. There are risks we need to consider. Risks include deceleration in sales and earnings as the market matures. The other thing we have to consider is the impact of tariffs, as well as potential export restrictions to China. Competition is always a concern for any business. Competitors again include Huawei out of China as well as AMD, which are launching new chips and technologies that could certainly undercut Nvidia's market share and margins. The other thing we have to consider is the markets may have overestimated the amount of capital expenditures major cloud and hyperscalers are making in artificial intelligence data centers. There's also a potential delay in the rollout for Nvidia's new Blackwell infrastructure. Eventually, Nvidia's growth will normalize. There are concerns about the sustainability right now of its high growth rates and margin pressures from the production of its new Blackwell chips. Now, in light of some of the concerns I just addressed on Nvidia, if we take a look at the technical picture or the price chart of Nvidia, we can see that the year-to-date performance is down about 16%. Irrespective of that, we still have to consider the stock is higher in the last 52 weeks by about 36%. Right now, the stock is unfortunately trading below the 50 and 200-day moving average, which suggests there's intermediate-term weakness in the price action. Now, to summarize, obviously Nvidia's commitment to innovation is reflected in its substantial investment in research and development, which has fueled advancements in artificial intelligence and computing technologies. The growth and profitability metrics for Nvidia are strong. This reflects solid operational performance, high product pricing, and data center market share advantage. While the company continues to expect to grow at phenomenal rates this year, with sales at nearly 60% and earnings at nearly 68%, we have to consider that these growth rates are decelerating. You really have to compare to last year, where actually sales were up about 114%, as well as earnings at 144%. This deceleration in the growth rate may help explain why the stock is down by about 16% year to date. Now, next week on the Tech Corner, we will be highlighting cybersecurity company CrowdStrike, following its recent earnings report. Additionally, next week is filled with other tech earnings. That includes Oracle, Adobe, D-Wave Quantum, as well as DocuSign. Thanks for tuning into the Tech Corner. Please be sure to like and subscribe to the Schwab Network here on YouTube. I'm George Tsilis, Senior Markets Contributor. I'll see you next week.